Welcome to a new episode of the Opening Bid Podcast. I'm Yahoo Finance Executive Editor Brian Sozzi. Like I always say, this is a podcast that will make you a smarter investor, period. And you are going to get much smarter because we have a great returning guest here on the pod, Rick Reeder, BlackRock Global Chief Investment Officer of Fixed Income. Rick, good to see you, man.
Good to see you.
It's been
Thanks,
a while.
sir. I know it's been a while. Thanks for having me on.
Of course. I was joking to you off camera. I have not spent... my career spans over 20 years. I've spent more time in the past 3 months talking about the bond market than I have in the prior.
Well, it's a good thing. We're trying to get you to do more of that.
Yeah, I'm sure. But it's been like this. I mean, it hasn't been a sleepy market, the bond market. But why is there so much attention at this?
So you think about we spent, more than a decade in super low interest rates. And by the way, you think about from 2014 to 2022, almost 9 years. We were in negative interest rates in Europe, negative interest rates for 9 years. So, you talk about somebody like, wow, can I actually put money in and pay somebody to take it? And so now, because you got inflation running at 3.5, depending on the measure you look at, central banks have to keep the rate high. Central bank keeps the rate high, and you can create portfolios of 6-7% yield. Particularly when you get the equity market at valuations that it is today, and you have pension funds, endowments, foundations say, "Gosh, get me a 6, give me a 7, and life is good without a lot of volatility." So it's become a really interesting asset class, but it's also the volatility of inflation has been pre-tariffs. Inflation's been high; it was supposed to come down, and now the future with automation and productivity, maybe inflation comes down again. So. Listen, the way we start every investment, we think about the risk-free rate. Like treasuries are the model that we build everything off of. Once you know the risk-free rate, then you say, okay, what will I pay for everything from private credit to private equity? But I need to know the risk-free rate. When the risk-free rate's moving around like crazy, it's like, wow, now how do I figure out my risky assets?
You take me back to my CFA training days.
There you go.
Risk-free rate. What is
you
it?
go.
It's like the capital R and the squiggly F in the models? Come on,
so
what do you think? I'm just a pretty face on camera?
No,
Come on, man.
That's pretty good. That is pretty good.
So, just looking at the debt markets, and I should mention this, you oversee $2.7 trillion in assets at BlackRock. Like, what's the past few weeks been like for you, and how are you trading and making decisions differently compared to the start of the year?
So I will say one thing: it is hard, and I would say sleep is not happening as often as but it has been intense. But I will say one thing about it that's been, this is a fun market, and so when news flow comes at you like this. One of the things that I found is when you get markets tend to overreact to things, and I find also, I think we talked about on your show once, they overreact in Europe more than any time, and there's a period in the morning that they tend to overreact, and markets like to go at the theme of the day. But oftentimes with some of this news, all of a sudden you get a piece of news, and then it changes the next day, and it reverts back the next day, and so if you're in the markets, quite frankly, going the opposite many days. It presents real opportunity, and people have gotten nervous about credit, and you get nervous about different asset classes. So, it's been a good environment to be active in and to be dynamic around. But I will say, you can't be confident in. And so what one of the things we do around it is when you get periods like this, I do a lot of relative value decisions a lot of times. Because your conviction, you just can't be that high because the news flow is so dynamic and by the way, based on things that are way out of your control. You can make a decision. You think about where's the economy going and usually it's pretty stable, and then you're making decisions around the margin. These are some pretty radical shifts. So, but it's presented some real opportunity, and that's made it fun.
As someone that oversees $2.7 trillion in assets, when do you wake up? When are you first checking overseas markets?
So by the way, somebody was laughing at me today because they sent me this long email, very long email at 4:30 in the morning, and I responded immediately, and after reading it, and they said, "What are you doing?" And so I get up. Listen, I like what I do, and I get up at 3:45 in the morning, and I usually get up without an alarm clock because, I don't know whether subconsciously I know.
Yeah, we're old war horses. I'm including myself in this. You just wake up 2:40 a.m. every day.
Do you know they once did a test? They use these systems, all these wearables now that test your stress. I swear, they told me, they said, when your stress peaks? And I said, no. They said 11:30 at night. I said, really? And they said, when your stress level comes down? And I said, when? They said 3:45 in the morning. They said, why do you think that is? I said, I know it is. When I have to put my phone down, you're not in control anymore because when my phone's on, I could see the markets. it's a weird thing. Like, how could your stress peak at 11:30 at 11:30
and you feel
night?
calm. Now you can see the markets waking up at what?
But it is like all of a sudden now I know. And if you want to do something, you need to do something. But anyway, it is. I get up because I find it intriguing. And every day, think about what's happening now. Rates are moving, equities are moving, gold's moving, Bitcoin's moving. Like the interplay of all these asset classes, something going on at all times, which makes it more fun. That being said, I do value my weekends because I will say, you wake up Saturday morning like, oh my God, thank God I get a day where
the 10 years not rising towards 5% on Saturday.
Yeah, totally. Although Bitcoin seems to move around,
right?
Yeah.
So there's been an outsized focus on the 10-year and it's climbed towards 5%. And I'll get to that in a second. But are there other moves in debt markets that have caught your attention of late?
So there's a big movement in the steepening of the yield curve. And one of the things that I was looking at this morning is pretty remarkable. So if you bought at the end of 2020, and people think about, I buy the 30-year as a hedge or I buy 30-year treasuries. Do you know if you bought at the end of 20, the value of your investment in the 30-year would be worth 64 cents today? Think about that. And by the way, the flip side, if you bought equities at the end of 2020, you'd be the S&P 500. You'd have $165 off of 100. So when people think about hedging and they think about what is a long bond doing for me, what are treasuries doing for me, not a lot. And so that is an incredibly different paradigm than anything we've been used to before. And then the steepening of the yield curve. So by the way, the front end of the curve's done quite well. And so the steepening of the curve's been interesting. Also, the interplay between markets internationally. What is Japan? What's happening with Japan? What's happening with their auctions in Japan? What's happening in the UK? So the interplay between different markets, and big one has been the diversification of people going into international markets that were own treasuries, and we've seen reserves in the U.S. that are held in, reserves in treasuries held in at other countries that they've actually declined, and they're buying gold and they're buying other international.
I'm glad you brought up the international component because maybe 3-4 weeks ago, I sat down with Treasury Secretary Scott Bessent, and I asked him, were there any signs of China selling U.S. debt? Now, I don't expect the Treasury Secretary to tell me on TV. We see that happening. Have you seen that? Given trade war concerns, we have concerns about the U.S. debt position, like any red flags in that area? Because it could have huge ramifications to markets, as you know.
Huge. So traditionally, China would use, they'd run as capital account surplus, and the money would go into treasuries. They used to hold $1.35 trillion of treasuries. It's down to $700 billion or so. So there's no question. The data's the data in terms of reducing. And by the way, the flip side is gold has been going up on the other side of that in an almost symmetric way.
So they're buying gold.
Correct. Okay. And you could see it. I mean, it's just in an almost symmetric way, reducing treasuries, buying gold. There are certain days where the activity level in treasuries, where treasuries are cheapening, and you tend to see this in the futures market, where I suspect that China is in the market doing something. You don't know. But at the end of the month or so, you can see, and what's happened has been pretty clear, China's reduced their manager. My sense is most of what they're doing is letting it roll off. So a lot of their treasury debt just rolls off over time. And my sense is that's most of what's happening.
So no sign that they're trying to put pressure on the U.S. via the debt markets?
It's hard to say, but listen, the numbers are the numbers in terms of their holdings going down. Now, I think a lot of it, whether, whatever it's around tariffs or what have you, they're funding their domestic. And you're seeing that around the world. The countries that used to buy a tremendous amount of treasuries, and that was their holdings or reserves, they're now funding their domestic economies. They have to. And buying their own debt. So I think that is clear in terms of what's happening. Now, whether in certain days they're more active than others, it'd be pretty hard to prove it. But, I watch these futures activity, and oftentimes you can't figure out where it's coming from. I don't know. Maybe more often than not, I think that tends to be a place it comes from.
It amazes me that the Moody's downgrade on the U.S. Kind of got swept under the rug. It was important for a day. We saw it coming. Japan gets a downgrade. Should we be paying more attention to these things? And why? How much of a problem is it longer term if we don't have that AAA credit rating?
So I think the one notch, was not, it affected the market for 2 or 3 hours. It wasn't so much a functional dynamic because most people are where are they going to go? They're going to buy a lot of Finland. There's not a lot of get me a AAA. Listen, at the end of the day, I think the size of the debt in the country is the most significant issue we have to watch for everything we do. Certainly in fixed income, but I would argue for other asset classes. we're rolling too much debt. Like we roll $573 billion a week of debt. That's like rolling Australia every single week. It's too big. It's too big. And by the way, this new bill will go through. We're not going to reduce it. I mean, we're not reducing the size of these deficits. So there's a compounding effect. The other thing that's happening is we're rolling off. So you think about for 10 years, we were issuing Treasury bills at 0% or 1%. Now we're issuing at 4, 4.25%, 4.5%. So the cost of our debt just keeps going up, and the size of it keeps going up. It's not tenable, and it's not sustainable. So I think it's something that, and I think Secretary Besson is focused on it. I think we have to focus on it. We have to get spending down, whether we're going to get it down. But the big deal is we have to grow faster. U.S. has to grow. If the cost of the debt in the United States is approaching 4%, we got to grow faster than that. It's the only way you delever an economy. So we just need to keep growing.
Yeah.
And hopefully, U.S. economy is pretty impressive about its ability to grow, but it has to grow.
Hang with us, Rick. We're going to go off for a quick break. We'll be right back on Opening Bid. Welcome back to Opening Bid. Having a great chat here with Rick Reeder, BlackRock Global Chief Investment Officer of Fixed Income. We're talking about the U.S. debt position. Given the mountain of debt that is likely because of this tax bill, how could the 10-year even come down? Are we just looking at a slow rise? Like, what's the worst case scenario, I guess, for you?
The worst case scenario is not a slow rise. The worst case scenario is that, listen, if the U.S. 10-year moves up, and I always found for years people said, oh my God, if the 10-year gets to 3%, the equity market is going, and then 3.25%, oh my God, 350 would be.
And look at the rally off the Liberation lows.
Totally.
Liberation Day lows.
Yeah, and so I don't think there's a number because we're in a really different paradigm today that companies don't borrow, don't borrow nearly as much as they used to. A lot of tech companies fund themselves through cash flow. Banks are asset liability matched. So it's not as important as it was. If it gets there really quickly, that's dangerous.
How does it get there quickly?
So, there were a couple, 2-3 Fridays ago where people were worried about inflation being higher and you'd have international selling. And, and there was, stories about Japan and others would have to sell treasuries. If it got there quickly, that is dislocating for the markets. And that is something that's by the way, two different ways. If treasuries got there, yields got there higher, or the currency, the dollar went down fast, either of those becomes really dislocating. Listen, if at the end of the day, dollar comes down moderately, inflation stays reasonably contained, it'll be okay, and the 10-year can move up in yield. By the way, it's not impossible for it to come down. I think in the next year or two, you're going to see a couple of things. One, I think the Fed's going to cut rates, and by the way, I think the Fed has to over the next 6 months, year, because we got to bring the cost of the debt down in the country. The same point about we got to grow faster than the cost.
Well, that'd be a new Fed chair doing that, right?
Right, and so by the way, it's incumbent upon whoever it is. It is a big deal, and they said we don't. The Fed chair would say I don't manage the fiscal situation in the country. That being said, it's a big impact. We got to get that rate down because we got to outgrow the cost. Anyway, that is a big deal. And then the other one is we just have to have inflation over the next couple of years. I think people underestimate productivity, automation, robotics. I think inflation's coming down significantly. By the way, labor replacement, et cetera. It's meaning you can have some wage deceleration. I don't know. I think anybody who says, I know what inflation is going to be beyond the next 6 to 9 months, I think is either lying or is arrogant. I think it's just too hard.
Well, I'm reminded because we just had an episode drop before you were talking to Goldman's Chief Information Officer, Marco Argenti, and he says we're going to be managing a workforce of AI agents, which is, wow. But that's productivity in real time.
Right, I'm pretty blown away. I mean, we use AI in some of our, how we look at research, how we look at, different functions we used to perform, stress testing, scenario analysis, looking at different permutation. I don't know. It blows me away what it can do. And so I just think it's to people to not say that it's going to have a negative effect on inflation, i.e. bring inflation down. I think it's going to be dramatic.
Some folks that I've talked to in the bond markets have told me this is going to be a challenging summer where yields will continue to rise. We'll have tariffs still in place. Are you on board with that? For markets overall, I guess we're looking at a convergence of bad things.
So, so one thing I will say about the summer. Summer is a time for not a lot of liquidity, and it tends to do some weird things during the summer. There's a lot of counterbalances to it. So I can't really say that's right. I think, hopefully we're getting some better inflation data that comes through. That could be helpful. The big one is, versus seasonals. If we get to what the tariffs, if we just get the news out, and between now and whether it's June 30th or July 9th, or I forget the exact date, I just want to know what the news is, because U.S. economy ends up being very durable, and we can withstand, if it's 15% effective tariff, U.S. economy will be just fine. I think people have been impressed. I've been impressed with everybody calls for a recession, and then you see this U.S. economy does pretty well. We just need to get the news out. And as long as we find out what is the tariff on China, what is the tariff on Europe, and as long as we get that news out, markets can breathe a sigh of relief. People are sitting in an immense amount of cash. Part of why I think these markets, like the equity market, goes up, there is so much cash, and people just sit on their hands and they're waiting for the news to be out.
Are you surprised by the rally off the Liberation Day lows?
The size of it, yes. Listen, you get pretty comfortable with, because I'm a believer U.S. economy is much more durable than people give credit to, service economy, technology-oriented. But I have to say, if you said to me, gosh, we're going to get the valuations with a multiple off of, let's take the last 12 months earnings, you're trading at a 24 times multiple. Off of next year now, and I think some earnings estimates will come up a bit, you're still at 21 times. If you said to me we're going to have 21 times with an economy that's probably moderating and uncertainty around tariffs, that's been impressive.
Analysts are still expecting for earnings growth to be double digits in the back half of the year. I don't buy it. I don't see it. I mean, I talk to a lot of companies, and they're calling out, at least to me, third quarter is when the SHI, star hits the fan. That's the first quarter of the tower. So does the market trade off in front of that?
So, by the way, it's been impressive. This last, the first quarter data that's come through has been impressive. U.S. economy has been on a pretty good tear. Second quarter, you have to believe you're going to start to see, including shipments that were made, including CapEx that was held back, companies just being conservative. The consumer was a bit conservative. Yeah, I think you'll see some of the data. I've said it many times, I don't think we're going into recession, or I think it's unclear. I think you'll see a divot of growth for a month or two. That could be significant. And then I think we'll work our way through it. So, listen, I'm looking at some of these earnings estimates that have, some have come down. Now they're getting revised back up. Even if you take the earnings estimates, I think double-digit earnings seems aggressive to me. But if you said mid to high single digit, the multiple on equities is still pretty full. I will say, I've run big equity portfolios. I'm still running a moderate long because I just look at the cash.
So you're still bullish, long, still bullish stocks.
Yes. Yeah. But I will say, and certainly in the last couple of weeks or so, we've bought some downside protection at these valuations because volatility's come down so much. The cost of hedging it has really come down. So we're comfortable running a moderate long. It's not nearly as long as we were, say, last year, what have you. But you can buy some protection. I don't buy long treasuries as a hedge. I think it's crazy. But I've bought some protection. But we can run a moderate long, and it's just every time I stare at the cash. And if there's no news, the market goes up. It doesn't need good news. It just needs no news. And the market goes up. So I don't know. It's you're pushing valuations that give me some agita, but I don't know. The cash gives you some comfort.
I want to get your hot take in the last minute and a half of the show. What's the best play in fixed income for the average investor right now?
Income that isn't fixed. I think. Listen, we're creating portfolios, and we run this ETF called Bink, and we're almost 7% with what is a high, well into investment grade, high BBB rated, with a 3-year interest rate, 3-year duration, interest rate sensitivity, income. I think, I was looking at those numbers I said earlier. If you held a 30-year treasury or 30-year long treasuries, your $100 worth 64. But what happens is income just keeps working, keeps compounding, and you don't have to go way out the yield curve and take the volatility. You're pointing about the 10-year. It's like, I don't really need it. Like somebody else can have that thrill. Certainly not the 30-year. But if I'm buying 3-4-year assets and I know the Fed's going to cut over the next 6 months to a year, like that income really, really works for you. And by the way, it doesn't have to be in funds we run or in, there's other ways to get preferred stocks. There's other ways to get income in a portfolio. At a time where valuations are high, like, boy, if you can clip 6, 7 and do different, that works.
You were one of the stars of our Invest conference last fall.
I'm
just listening to you. I was like, now I know why you got great feedback.
I don't know about Start, but it's a cool conference.
Thank you.
It gets a lot of attention.
Yeah, we're gearing up for another big year. Good to see you. Appreciate it.
You too. Thanks for having me.
Yeah, of course.
Was fast.
Yeah, 24 minutes on the pod just goes like, there we go. Rick Reeder, BlackRock Global Chief Investment Officer of Fixed Income. Good to see you, and we'll talk to you soon.
Thanks, Brian.
All right, and of course, continue to hit us with all those likes on YouTube, all the love on the podcast platforms. I think it's a bunch of hearts. Love your feedback. Love the interaction. We'll talk to you soon.